All right, so let's get started. So as usual, we have a disclaimer. We just want to make sure that everyone who joins us for all our presentations do know that we are a non-profit organization. We are not licensed by MES. Obviously, we are an advocacy, and we do. Our mission is, of course, to champion the rights as well as the interests of retail investors in Singapore. But we do not actually give out recommendations or whatever we say this evening and in all our presentations is obviously an opinion. So you shouldn't just run out to buy a stock if we mention it and whatever. You should actually speak to a licensed financial planner or financial advisor before you make any kind of trades. All right, so that's the disclaimer. Okay, so this evening we are going to be talking about a couple of stocks, but again, it's not a recommendation, right? So do consider carefully before you make any kind of trades in the market. Now we're gonna first start off with, all right. So we've got a question already coming in from the Q&A, but before we get to that from Mr. Wu, we do have 3 questions that we're gonna get to first, simply because they showed up in our vision hole. And so once we get through all these 3 questions, and it's just going to take a few minutes, then we'll get to the questions that may show up in the Q&A panel. All right, so the first question that we've got is about Izion as well as other similarly suspended kind of tickers. So how to get an update on the suspended counters, Izion, High-Flux, Minders, whatever. That's one question. And the second question is on the conservative side, the suspended counters have got 0 value. What are our comments? All right, so let's deal with the first question. Now, according to the SGX, the exchange rules, suspended stocks or other companies still have to provide updates every 6 months. All right. And if you want to kind of get the latest, there is a section of the SGX website where you can actually find out whether the company has made any kind of announcements or whether there've been any publicly announced corporate actions. And these are the 2 links. All right. So if you can't remember the links, that's fine. You just go to the SGX website, right? And then look for the tab that says announcements or corporate actions. All right. So do take note that you might not see anything for a long time because if the company adheres very strictly to the SGX exchange rules, then they need only provide an update every 6 months. Okay. The other thing that you want to take note of is SGX does not provide any kind of investment advice. So whatever updates that do show up there are going to be devoid of any kind of opinion or recommendation. So it's going to be straight from the horse's mouth, in other words, from the company itself. All right, so this is where you can get updates. Now, from a personal perspective, I think it's always good to try and find out as much as possible about suspended counters, but also do take care, because apart from this SGX website, obviously normally what we do is we will Google some of these counters to see where they are. But if you do, log in or join some of these investment clubs, do again take note that none of these investment clubs are licensed by MES. So again, the opinions, right? So really do consider all these things and think about it before you make any kind of moves in the market. All right. Now for the second question, the suspended stock is worth 0. That is technically not true, because the company itself is not worth 0. The stock is not worth 0, and the company itself is not worth 0 unless it's really insolvent. Okay. Now usually the company has some kind of residual value. Accounting wise, we call this the net book value, which is basically the assets minus the liabilities. All right, so if there are more assets compared to liabilities, if the company wants to dissolve itself, it can sell all the assets, use the cash, pay off all the liabilities, there's something left, right? And then the administrator can then, of course, apportion all of these things back to the shareholders, all right, prorated. fashion. So that's the net book value. Now this is obviously not ideal, simply because when you buy a company, you are more interested in getting dividends and make sure the company is well run and stock price goes up. But of course, in the worst case scenario, there is still residual value. So that's one way of calculating it, is the net book value. Now, the other way of calculating it is, of course, the salvage value. If the company has got very liquid liabilities or very few liabilities, then the estimate of what the company is worth is, of course, how much the assets can be sold for. All right, now this is, of course, a little bit tricky because if you have a company that has got a lot of PPE, as in plant, what is PPE? Plant, something, and equipment. Is he getting old already? But anyway, we're talking about fixed assets, right? So if you're a company, we've got a very big building, factory, so on and so forth, then obviously that's easy to value. But if the company has got a lot of intangible assets, things like brand value and goodwill and all that, then it's going to be a little bit trickier to convert that to cash. All right, so this would, of course, yes, property, plant, and equipment. Thanks, Ming Zhao. All right, so as you can see, 老人家就是这样啦。All right, so that's the PPE part of it. Now, if you, of course, were to buy let's say a financial institution, a brokerage or something, and then it goes under, then that's going to be a little bit tricky as well, because most of the assets and liabilities it's not fixed assets, right? So it's basically things like financial assets. So that could be a little bit more complex. All right, but generally speaking, the company is not worth less, even if the stock is suspended. Now, the other factor you want to think about is that usually when a company is not doing well, if you are, for example, high flux, then the company will be looking around for somebody to try and, strengthen its balance sheet. Maybe they want to do a merger. Maybe they want to sell itself to another company. Now, usually what we call that other company, we call it a white knight, right? We come in to save the damsel in distress. All right, so obviously the white knight will have some kind of offer, right? And that would also can be taken as a so-called fair value company at that point in time. All right, so the company is not worthless. Now, the main problem with retail investors, right, is that when a ticker is suspended, it means that you can't get out, right? So this is basically a loss of liquidity. All right. Now, what you need to remember is that the stock market is simply an exchange, a marketplace, but you don't have to sell your stocks on the marketplace, right? The benefit of selling on the marketplace is that you don't need to know your counterparty, because other people will come to the marketplace. You don't need to know their name and all that. You sell to the exchange sells to them. They buy it, they pay money to exchange, the exchange pays you. So you don't need to care about your counterparty. But that's not the only place you can go to sell your stocks. You can actually sell your stocks off market. So you can agree with somebody, find somebody else that wants to buy your stocks. You find that somebody, you agree on the price, you agree on the terms, you sell it, and then both of you, both parties, go back to the exchange and tell the exchange record it as a married trade. Married trade, right? So you do the deal outside, come to the exchange, get it recorded, get the ownership change, so on and so forth. That is also possible. Now, the challenge for retail investors is that how do you find a counterparty, right? Normally, married trades are more workable. If, let's say, the two parties are big companies, let's say a very huge investor, maybe the founder wants to sell his stock, but of course, if he dumps his stock on the stock market, the price might change. So he might find a hedge fund or competitor, and he sells the stock directly. So once this person they agree on the trade terms, then of course you go back to SGX and say, okay, we agree on these terms and please record it, and that's how it's done. Okay, so but for retail investors, because the number of shares is very small, it's very difficult, as in it's not worth the hassle, the cost and all that. So that's where the problem is. All right, so I guess just to keep it real, if the stock continues to be suspended and eventually gets delisted and the company is wound up, then the administrator will need to come in to kind of deconstruct all the, of course, sell all the assets and all that, and on a pro rata basis, basically give the money back to the shareholders. All right. So it's not good news. I mean, obviously, you're not gonna get as much money as you uh, paid for the stock unless you bought it at a very low price. But it's not zero. Okay. All right, and we have got the second question for retirees seeking stocks with reasonable or good dividends, yet stable and not volatile. What do you recommend highly from SGX? So, just for the avoidance of doubt and just to make it clear to all our friends here, at SIAS we don't give recommendations, we don't make recommendations. So whatever I'm gonna say in the next 5 minutes, don't take it as a recommendation. You know, you should actually um, be a little bit skeptical about what I'm gonna say, and do find yourself a licensed financial advisor and speak to the person about what I'm gonna say in the next 5 minutes. Don't stray away and go out and buy whatever I'm gonna talk about because it is strictly not a recommendation. All right. And now for this kind of need, you want something which is stable, good dividends. Then one of the type of securities would be REITs, real estate investment trusts. The reason is because generally they have got quite a stable business model, right? So they are landlords. What they do is they rent out the units to tenants. Tenants pay on a monthly basis. There is a contract, so maybe it's a 2 years plus 1 year option, depending on the type of tenants. Then depending on the type of tenants, then you're gonna have you may have a very stable business. So obviously the risk factor nowadays is COVID-19. So you got shopping centers which took a big hit when we had the phase one of the circuit breaker. Of course, same for the offices. People are working from home nowadays. Um, but the thing is, there are other types of REITs which generally didn't really close. So, for example, the healthcare REITs, right? So you've got hospitals run by REITs, and if you're sick and you need to go to the hospital, you have to go to the hospital, right? So those were not as badly affected as the retail as well as the office REITs. All right. Now, what I'm going to talk about is, of course, Suntec. There are a couple of reasons that Suntec may be appropriate for investors looking for stability as well as relatively high dividend. One of the reasons here is if you look at the bottom left of this screen, you have got this thing called market cap. The market capitalization in Sing dollars for Suntec REIT is 4.2 billion Sing dollars, right? So if you're going to be investing in this for a long time, just collect dividends, right? You don't want to invest in something which is, as they say in French, kucing kura. Huh? You want to have something which is big and not at ikan bilis, simply because of the way REITs work. So the REITs have to buy property. So obviously you want a REIT to be financially strong, a very healthy balance sheet, and market capitalization is a not 100% correlated, but it's a good reflection of how strong the balance sheet is. So 4.2 billion Sing dollars is relatively large in the Singapore context. Obviously, if you compare this to US stocks, that's nothing. But in Singapore, $4.2 billion is not small change. So that's relatively good. Now, the second thing that might be helpful is that the percentage of the free float, if you look at the line below that, shares outstanding slash float. So the free float is 1.3 billion shares compared to the share outstanding is about 2.8 billion shares. So that's about, I don't know, 45%. So what it means is that 45% of the shares out there can be traded freely, right? They're not restricted in any way. So I kind of like that because again, relating it to the previous questions, liquidity is important for investors. So if you have got a relatively high free float, it is very easy to buy and sell this particular stock. So that's all good. Now, the other thing would be if you look at the price earning ratio, current price earning ratio is 14.39, which is relatively okay, because if you look at the entire STI index, or let's say equity indices in general, then a P ratio of between 12 to 18 is kind of normal. So if you see a P ratio of 30, 50, that is a bit pricey. If you see a P ratio for a stock, let's say 8, 6, that is probably too cheap. So, there could be something wrong with it, or maybe it's overlooked jewel. I don't know, but 14.4 is kind of okay. So rule of thumb, that's okay, not too expensive, not too cheap. But if you look at the estimated PE ratio at the end of this year, end of December 2020, it's gonna be estimated going to be about 30.2, which is I think quite reasonable given the drop in earnings as well as the phase one, phase two circuit breaker that has locked down most of Singapore for this year. All right, so the full year results, if you look at the P ratio at the end of this year, it's going to spike to 30.2 simply because earnings are going to be lower. But I think that is reasonable because it's one risk factor, right? It's not as if the company is poorly run. I don't think so. It's simply because of the circuit breaker. Right. The other thing that could be very helpful is the yield. If you look at the section in the middle below dividend, right, the indicative gross yield, it's 5.7%. That's relatively high. It's not as high as you can get for a REIT, right? REITs can hit 7, 8, right? But I guess given the ongoing complexity with the COVID-19, I think it's pretty okay. And if you look at historical growth in the dividend, the 5-year growth rate is 3.26%, which is kind of nice as well. All right. So, excuse me for that. So you need to excuse me for that. So in my jobs, I need to use my voice quite often, so presentations as well as seminars. Okay, so that is on this slide. Let me just move to the next slide. Let's look at the price behavior. Price behavior of the stock. This is since 2005, so we're talking about the last 15 years. As you can see, this stock kind of collapsed during the 2008-2009 period, but of course we know what risk factor that was. That was the great financial crisis. So again, nothing to do with Suntec REIT. Basically, globally speaking, every stock took a big whack and fell. So that's fine. But since 2009, this stock price for REIT has been on an uptrend, right? So higher highs and higher lows. So that's the traditional definition of an uptrend. Of course, that trend kind of fell apart earlier this year because of COVID-19, right? So as you can see, in the earlier part of the year 2020, the price collapsed. But of course, it's been on an uptrend since then. Now, as you can see, I don't really think there's any issue with the price return of Suntec because in cases where the price did drop quite a fair bit, it recovered. And on a long-term basis, the price is still going up. All right. So if you're looking for a stock for a dividend play that you can hold for a long time, I don't think this should be an issue. So whatever volatility that you get in the short run, right? That's not something to worry about. Okay. All right. Moving on, let's focus a little bit more on the dividend because for REITs, traditionally the price return is not great. All right, so but the bulk of the return is going to come from dividends. So as you can see, the 12-month dividend yield, that means the trailing 12 months, was 6.46%. All right. What is more interesting is that if you look at the chart below, you have got the white line and the what's that? The orange line, right? The orange line is the actual dividend in dollar amount. So the current dividend is 8 cents, I think. And if you look at the white line, that's basically the dividend yield, right? So in the middle part here, you can see that the orange line is kind of hovering about 10 cents. Is it 10 cents? Yeah, 10 cents for quite a fair bit, while the white line keeps going down. That's simply because although the dividend in dollar amount is a fix, but the dividend yield keeps going down simply because the stock has appreciated in price. So I think that is a good problem. I don't think that's a bad problem. But of course, heading into this year, as you can see, the last few quarters, the dividend yield has dropped quite a fair bit, as well as the actual dividend in dollar amount. So that again is pretty expected given the circuit breaker, so on and so forth. Now, the good thing is that early on in this year, the Singapore government has stepped in to help both the REITs as well as tenants, right? in terms of the amount of dividends that the REITs need to pay out to shareholders, in terms of giving more time to tenants to pay for rent, so on and so forth. So I guess we are all in this together. So the dividend is down, but I think that is forgivable given the current situation. Now, if you look at the long-term dividend trend, right? I think where's the long-term dividend trend? The left-hand side, right? So you look at the what you call the vertical axis on the left-hand side. The white line, that's the dividend yield, kind of hovers between 8%, and the lowest was about 3.5%, right? I think that's quite okay. So when the dividend yield dips below 4%, is usually because of some kind of issue with the macro environment, the great financial crisis or the COVID-19 pandemic. But when we talk about, let's say, business as usual, if you look at the business as usual, the big middle part there, you can see that the dividend yield is normally north of 5%. So it's between 5 to about 6.5, which is quite respectable. All right. So if you look at, let's say, 5% dividend yield plus another 3% price return, then you get a very nice total return of 8%. For relatively low volatility. I think that's quite okay. Now, of course, what's going to happen in the future, and this is quite interesting. We have got analyst reports, but apart from reading all the analyst reports, yourself and falling asleep, we do have a summary here. As you can see, there are, how many is this? There are 14, 16. 16 different analysts that cover Suntec REIT. 17, huh? 17 companies, research analysts that cover Suntec REIT, and about 50% of them have got buy calls, 6 of them have got sell calls, and you got 2 holds. All right. As usual, always take this with a grain of salt. But if you look at the price for Suntec REIT as of this afternoon, it was $1.48, and the target price, the consensus target price, is $1.59. So there's still quite a nice upside potential, about 7.4%. But of course, don't always take this as the Bible truth. What I like to do is to give it a haircut. So if the consensus is a upside of 7.4%, I'm probably, it's probably not going to hit 7.4%. So, just be on a little bit on the conservative side, maybe you'll reach about 6% or so. So you can just give it a haircut. So you can think about it, right? So are you happy with 6% price return in the next 12 months plus another, 4% or 5% dividend yield? That will be, north of 10%. I think that's quite respectable for a stock that you can hold for the next 10 years. Again, for all our friends out there, this is not a recommendation. All right. Okay, so that is for the second question, Suntec. Let's head into the third question that we had in the pigeonhole, and that will be on Sunli. Sunli is a $14 million market cap company, and the question is, what is the outlook for Sunli? Its share price has fallen significantly since its IPO. Now, just a very quick profile here for most of our friends. They may not be familiar with Sunli. Sunli is basically a company which specializes in the design, supply, installation, and maintenance of mechanical and electrical equipment. All right, and they are also in the waste water treatment space, and they serve basically Singapore. All right. Now, if you look at the bottom left, the market cap for Sunli is $14.2 million. That's actually quite small. All right, $14.2 million. I can see that in 20 years, Fang Boon will probably own a house, which is $14.2 million, or maybe in the next 5 years, right? So that's relatively small. So jokes aside, that's relatively small for a listed company. And, with a relatively small size, then, there's kind of higher risk factors, because if you've got a smaller balance sheet, you might not be able to ride out the volatility in the macro environment. And the other thing is that we want to point out is that if you look at the shares outstanding versus the free float, the free float is 45.5 million shares, and the shares outstanding is the 268 million shares. And that is only about 20%. All right, so 20% of the share outstanding is free float. The rest are basically restricted in some way. They're held by institutions, held by insiders, or whatever it is. So that's relatively low amount of liquidity, right? If you look at the middle section, the PE ratio is 44.17. Now this is really expensive, probably because the earnings are very low, which is true for this particular stock, which we will see in a minute, right? And the other thing that we want to consider is that the gross dividend yield is only 1.13%. Okay, now just blow this up a little bit. The price for this stock as of this afternoon was this 0.05 cents, right? The PE ratio 44.2, which is relatively high. And of course, the dividend yield is relatively low. Now, the other thing that you want to consider, if you look at the fourth line from the top, the price to book, P/B, that's price to book, that's 0.54. Yeah. So normally the price to book should be at least 1. Normally it's higher than 1. The reason is because you remember just now we are talking about the net book value. If you sell everything in the company, you got some cash left, and this you can give it back to the shareholders. But with a price to book of 0.54, it means that people don't think that the company is actually worth as much as it is, because once they sell everything, people don't see $1 as $1. People see it as only 54 cents. So there is, this is kind of an indicative that the market doesn't think that the company is has got a strong balance sheet, right? So this is not really good, right? And if you go down to the profitability, the first line, operating profit margin, pre-tax margin, 1%, yeah, that's quite low. And of course, that bleeds into the performance matrices like the return on equity, return on capital, 1.2%, 1.7%. To be quite honest, that is actually very, very low. It's okay. If you look at the earnings per share, the bottom one, it has been sliding. So 2020, the earnings per share is 1/10 of 1 cent. Yeah. So as you can see, I think the price has kind of moved down quite a fair bit simply because of the deterioration in the earnings per share, as well as on a longer term basis, if the return on equity and return on capital is relatively low, then generally it doesn't bode well for future stock price performance, right? If you again go back to the research analysts, nobody covers this anymore. There used to be one chap, Wang Quan Lam, SAC advisors, that used to cover it. But that stopped in more than a year ago. So nobody covers this. And I think that's also why the price has not been going up, because nobody covers it. Nobody knows what's happening in the company. The company has not announced any kind of upside catalyst, so it's not terribly exciting. So it's kind of floating down. And because of the low free float, nobody trades it. So it's kind of like, okay. So the question here is, what's the outlook? And to be frank, I don't know what the outlook is because there's no research. And this is a relatively small company, and it is in the business of doing maintenance and installation. And to be honest, this is not a terribly complex kind of business. It is not like Tesla or Apple or Google. This is just installation of equipment and maintenance, and it's a relatively small company. So I don't really know what the outlook is going to be, but the company is relatively small, right? So it wouldn't be something that I want to hold in my portfolio. If you look at a price, it's been coming down quite a fair bit. If you look at the price since the early part of this year, is basically been doing nothing much. All right, it's fallen quite a fair bit from 40 cents all the way now it's about 5 cents. Yeah. All right. So I guess the bottom line is that this is not a very popular company. Not many people trade it. There's no outlook because there's no research coverage. So it's I guess it's a big question mark. Don't know. All right. Now we do have a couple of other questions. So the first one is from Yuan Tuck. As a long-term dividend yield investor, which accumulation strategy is preferred? Averaging up or averaging down? I'm not sure, because the long-term strategy is that you just buy periodically for a long time. So whether it averages up or averages down, it depends on the price that you buy. But the long-term strategy is to continue buying, right? So it's like every quarter you're gonna spend X amount of money, and you're just gonna buy into the fixed proportion that you have already created for your portfolio. So obviously, if you buy a low price, then you'll be averaging up. The dividend yield is going to go up, right? So if you buy a high price, then the average of the dividend yield is going to go down, right? So I would say that it's not particularly, um, it's not really a fixed strategy, right? I guess the focus on the strategy of a long-term portfolio is to buy at a fixed time, um, you know, throughout the year, so that you are always invested. And just to kind of um, supplement that, a lot of the banks in Singapore have come up with this product called a regular savings plan. Basically, you just tell POSB or Maybank, whatever it is, that every month take $500 out of your account and then buy these stocks. So you will predefine the stocks or the ETFs that you want them to buy, and every month, boom, they'll just do it automatically. And it's great. You don't have to kind of click a button. Everything is done automatically for you. And of course, once in a while, you will go back and look at your portfolio and you want to kind of rebalance it. That's fine. But that's from a strategic perspective. You don't have to deal with the timing and the execution. So all the thing about averaging down, that's, you'll just offset and you'll just wash out, right? So automatically you'll just be taken care of. All right. Right. So the next one is from TK. Are there merit trades done during regular trading? Is it reflected in the volume and price done for the counter for that day? To be honest, I'm not sure about the operation side of things. I don't know actually. I can try and find out from some of the brokers that I know who are still in the market. But I don't know whether a merit trade done today or recorded today or being told to SGX today will be reflected in the price today. I'm not sure whether there's a lag time and all that. Maybe I can go and find out from some of the brokers, and we'll post it on I don't know, on our Facebook page or something. So that's a good question, right? I'll get back to you. So the next one, holdings in Hong Kong Land and NM2 Asia. Don't really know what to do with them. Any advice for the next? Okay. Now the thing is this, right? We don't really give advice and recommendations. I think what we should kind of focus on is, okay. So let's go back to kind of my slides, right? And I'm kind of turn this question into a little bit of education here, right? So some of the key things that we generally look for are things like the profile, right? So from the company profile, we will understand the business model. From the business model, we understand, what drives the company, how do they make money, what are costs coming from, so on and so forth. We also look at things like the market cap. Is it a small company or big company? We generally prefer big companies for long-term portfolios. The amount of liquidity that the company has in terms of the percentage of free float. Of course, also the relative pricing, sorry. So things like price to equity, price to book, as well as dividend yield. Now, obviously, not every company or not every stock in your portfolio is going to have very good dividend yield, but it's fine because normally there's a offset. Companies which don't have a lot very good dividend yield normally are growth companies, so you're going to make it up with the price return. Companies which don't really have got very good price return, like REITs, they will make it up with the dividends. So it depends on how you want to get your return, right? What kind of volatility that you are able to stomach or feel comfortable with. And the other thing for a long-term portfolio is that we're not really interested in when do we want to buy. We just want to kind of find out whether the company is in a what part of the cycle it is. So if you look at, again, coming back to Suntec, right, you can see that structurally speaking, this company has been in an uptrend for a long time, and the only times when it's kind of went down, you recover after a few months. And the thing is that if your time horizon, your investment horizon is the next 5 or 10 years, it's okay if the stock price drops for the next 5 years, 5 months or 6 months, but then you'll come back, right? So that's entirely fine. All right. Again, for this kind of portfolios, then of course dividend yield is something that you're going to look at. And of course, the last thing would be outlook, because we don't want to get into a situation where we have got buyer's remorse. As you know, what's buyer's remorse, right? So you run out and buy yourself a very fancy Prada bag, and then tomorrow they say, "Oh, great Singapore sale, right, half price." Then you feel like an idiot. You should have waited for 1 day. So we don't have buyer's remorse. So that's where we want to look at research analyst outlook, right? So execution is not so key, as in we don't really care when we buy it in a way, because the thing is we're going to hold it for a long time. But again, from a psychological perspective, I will prefer it to buy it when it's on the low end rather than high end, because I just don't want to feel dumb. Yeah. All right. So these will be some of the things that we're going to look at. So that's not a good answer to your question about Hong Kong Land and MM2. The reason is because I'm not particularly familiar with those stocks. And you know what we can do is that the reason is that because this is a question that just came out, but I don't have my Bloomberg machine in front of me, so I can't quickly just go and type it up. But what we can do is that we can keep that question. So for Hong Kong Land and MM2 Asia, we can come back to it after we had a chance to do some in-depth research. Would that be okay for you? If you're going to be logging on next week, we will come back to these two companies with a lot more analysis for you. All right. CRCT. Let me see. Yeah.
Ben, maybe I can step in for CRCT.
Okay.
So CRCT, if you are a member, shameless product plug here. So there will be a dialogue session with CRCT tomorrow afternoon. So that is to understand the latest proposed acquisition into the industry and the business parks in China. So I think CapitaLand has explicitly mentioned that they're gonna use CRCT as a capital recycling. Use CRCT for the capital recycling of their China assets. So and currently CRCT is 100% retail. So what they look to do is to really move more into the diversified portfolio. So you get maybe 40%. If I get the numbers correctly, about 40%, about 1/3 each for integrated developments, retail, as well as the industrial / business park. So I think, after all, you got a strong sponsor, CapitaLand, as well as the diversity of portfolio. I think it seems like a good proposition, at least for the proposed acquisition. But if you can, please join us for the dialogue session tomorrow afternoon with the CRCT.
Okay. So that's for CRCT. So as you can see, we have got quite a few things going on, and now it's kind of the season for mergers when it comes to REITs and some of these stocks. So always good to try and find out more. Okay, so there are two questions here about a digital banking license. Maybe I'll just kind of combine them. So the digital banking license have been awarded, Grab, so on and so forth. And one of the questions would be, what is the implication for banks, right? Okay, now let me just do a quick, just kind of elaborate on the business model of banks or financial institutions. Okay, so there are two parts to a bank, right? Two types of businesses. You have got the flow business FLOW, the flow business. The flow business is really the commissions, brokerage fees, right? So whenever you trade through a bank or you buy a unit trust fund, if the unit trust fund is not run by the bank themselves, then they basically get a commission, right? So that's the flow business. So every time you use a bank, they're gonna charge you. They make a commission because they're the middleman. This is flow business, right? And of course, the flow business also will be things like your what you call like investment banking fees, right? So when a company wants to do an IPO, the bank does it for them, so they get paid. That's a flow business. So it's based on the volume of transactions. And then you've got the AUM business, the asset under management business. You can think of this as if you buy a unit trust fund from the bank, and the bank is the fund manager, then you have to pay an annual management fee, right? So the annual management fee could be, I don't know, 0.5% of the amount of money you put in. So you put in $10,000, so you need to pay them $500 a year. All right. So the more money you put with the bank, the more they charge you, but the percentage is the same. So that's the AUM business, right? Now you've got companies like Grab, right? So Grab was issued a digital license, and now you think about the business model of Grab. How do they work? All right. So you order food, comes to your door, you get charged. You want to get a cab, travel, you get charged, so on and so forth. So on one hand, you look at it, they're basically a middleman, right? They connect you to whoever is going to be providing a service, so they get some money out of that. But the thing is that every second of every day in Asia, people will be using Grab. So which means that over time, they have collected a lot of cash. And this is like real cash, like real time. So you click only, they're going to charge your credit card, zap out, right? It's not like, they get paid 3 months later, no, straight away zap, right? It's out because you gave Grab your credit card. So straight away, pop, 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 every second, every day, the money rolls in, right? So generally speaking, they have got, quite a fair bit of money lying around. So which means that the balance sheet is relatively strong because they've got a lot of liquid assets. They don't have things like PPE and furniture and factory, but it's basically just liquid cash because it just comes in, right? So it makes sense for them to get a digital license because then they can actually provide the services that a traditional bank has. I mean, what do you do with a bank? You go and borrow money, right? Well, I don't know what kind of services Grab is gonna do. Going to offer once they start operations. But if they're going to be competing with a local bank, then I suppose they're going to be using their balance sheet to lend people money, right? So it kind of makes sense if, let's say, your company has got a lot of cash lying around to get a digital license. Now the other company, of course, which has got a lot of cash lying around is Apple. Apple, right? They've got billions of dollars just lying around because they are very profitable. But Apple, of course, have not gone into the into that part of the business. But you think about Apple, if they got $100 billion cash just lying around, they can suddenly become a bank, right? Already they are the world's largest hedge fund, if they were a hedge fund, because they got so much cash lying around. So the way to look at this is, you think about the business model of the company that got the digital license, thinking about why did they do it? Because they already have the AUM business, they want to get into the flow business, right? Or they already have the flow business, they want to get into the AUM business. And then you think about the kind of services they'll provide. So obviously having more competition in the local banking sector is no good for the incumbents, but it is good for us consumers, because more choice is better, right? And of course, more competition will lower costs, or not lower costs, but lower prices for all consumers. So that's good, I think. All right. Another question about glove stocks. Like companies making gloves. So you're talking about the
Glove kind of stock.
like Top Glove and all that, right? Like the ones used in healthcare, right? All right. So I think the rage right now is for personal protection equipment, again PPE, but different PPE, personal protection equipment. And you can see, of course, is a big deal because of what's happening in the pandemic. But the other way of looking at it is that this is basically a cyclical effect, because of the current situation. So once things die down in 2021, 2022, then you're going to be back to business as usual. Okay, so that's one thing. Now the second thing is, of course, all right, you want to make a very good hygienic, safe kind of glove. It requires a fair bit of technology and infrastructure and so on and so forth. But on the flip side, this is not rocket science. Making rubber gloves is not rocket science, right? So you want to do it in a country where labor cost is cheap, so on and so forth. So that's why it doesn't make sense to do it in Singapore or the US. You do it in Malaysia, Vietnam, China, right? So as long as the standards are high enough, you can make rubber gloves. So we're not talking about things like Tesla or SpaceX or some kind of rocket science kind of thing. Not really, right? So the way for this kind of companies to remain relevant, right, is that they need to obviously keep reducing costs, right? Because you need to reduce costs, sell by the millions, so on and so forth. You make a very thin margin, right? So that would be the business model for this kind of companies. Yeah. So if you think about it, there's not much to stop a competitor to come in. It's only economies of scale that is, protecting the incumbents right now. Economies of scale, because they've been there first, they do it very well. They're well-known, well-known safe name. So, people keep ordering from them. But really, it's apart from that, economies of scale, not very defensible. Not very defensible. Yeah. So that could be one thing that you want to consider. And the margins are normally very thin, right? So they make only a few percentage points. They definitely need to sell a lot. Okay. Okay, for me, my personal portfolio, I wouldn't buy this sort of company because I like companies which have got an economic moat. Like it's a castle, there's a body of water, you need to cross the water before you attack the castle walls, right? That's what you call a moat, right? So companies like this don't really have a lot of moat, right? So I like companies which have got a lot of intellectual property, very big size, almost a monopoly in their chosen sector, and have got a lot of network effects, right? So Apple has got a lot of network effects. So does Google, Facebook. So you buy an Apple iPhone, you're probably gonna be using it in conjunction with your iStore products, movies that you buy, so on and so forth. So this is what I call network effects, right? So Disney also has got a lot of network effects. So you go to a Disneyland, you buy the T-shirt, you buy the toys, you walk out, come back to Changi Airport, you wear the Disney T-shirt. Oh, people like that, and so you're locked into the Disney ecosystem. So I like the kind of companies, right? Okay, so so that's my 2 cents worth of glove, those kind of glove companies. All right. So what are the indicators investors should check while buying a stock? Are we talking about fundamentals or technicals? Okay, so if you're talking about technicals, then I usually use the very boring type of technical. So you got the moving averages, RSI, MACD. So nothing fantastic, and normally I'll just use the default. Whatever my trading platform is, just use the default. I do look a little bit at the candlestick. Whether it's shooting star or hammer, but I'm not great at candlestick. So that's kind of the things that I use, and I like chart patterns. So things like head and shoulders, double top, double bottoms, ascending triangle. All that is very interesting to me. And just for fun, because we are friends, and just to waste a little bit more of your time. Actually, I found something quite interesting for Apple. Apple, the things that Apple, the world's most valuable company, and I'm a little bit hesitant on showing the chart Apple simply because my monitor might crash. But friends, if you're familiar with technical analysis, right, and you got nothing else to do this evening other than to hear us talk, you can actually go and check out the chart for Apple. You might actually see that Apple has developed into a ascending triangle chart pattern, ascending triangle, and that's traditionally a bullish triangle, a bullish kind of chart pattern, right? And it kind of works about 65% of the time, right? So it's about 2/3 of the time it kind of breaks upwards, right? So you want to kind of check that out, right? So things like that, chart patterns, ascending triangle, descending triangle, flags, that kind of thing. I like that because it's easier for me to kind of understand that compared to what you call the candlesticks and all that, like the three advancing soldiers, that kind of thing. I can't really get it, right? 老人家就是这样了，看不到了。Yeah, so anyway, that's again not a recommendation, but if you're interested, go check out Apple. I think that's quite an interesting chart pattern. The ascending triangle has formed. And again, I think something should happen. Globally speaking, if you look at equity markets, it's like we're all holding our breath. Volume has dropped. If you look at the average volume over the last week has dropped, but markets still keep going up. And that's not really a good sign. And then it's moving into the overbought territory. So always not a good sign. And I think my screen has gone berserk. Okay. Never mind. We don't need the PowerPoints anymore. So just do take a look at that if you're interested. And the other question is. Okay, the other question, what other questions do we have? So that will be for technical analysis. Okay, so the last question would be the property counters going forward in 2021. Yeah, so the thing about property counters is a couple of moving parts here. In the long term, obviously property prices in Singapore are gonna keep going up. Okay, so that's always good. You have got a small amount of land available. And at the same time, probably developers will always be needing to top up their land bank, right? So whenever the Singapore government, has got a tender offer to sell a piece of land, even if the property developer doesn't want to build something there immediately, normally you need to top up the land bank. So there's going to be an ongoing demand there. Now, as you can see, and I think I read the newspaper report, was it yesterday or the day before? So property prices seems to be bouncing back a little bit despite the COVID-19 pandemic, right? I think in the long term, I think that's when things go back to normal, property prices are going to start coming back, and therefore that is going to be good for property developers going forward. Yeah. Okay. Why do you think IFA's price is rising again? Yeah. Okay. I didn't see any kind of fundamental news about IFAs. Do you see something, Fangwood?
I'm not too sure.
Not really, right?
Yep.
But wasn't it because IFAs?
It got oversold on Monday. I think down 30%. So.
But it could be also because they didn't get the digital banking license, right?
Yep.
Yeah, so maybe the price kind of collapsed or dropped a little bit because of price taking, as well as they didn't get a digital banking license. So the price has bounced up a little bit. Maybe it could simply be because of price recovery, right? So it was oversold and people are just buying back. So this would be some of the technical reasons. Apart from not getting the banking license, we didn't see any kind of fundamental factors when it came to IFAs. All right.
Yeah, I guess maybe just the performance, especially with, I think we have covered this in the Monday session. So the performance, especially with more retail investors getting on board over this COVID period, that could see a very short-term performance spike, and hence, I mean, people might be just getting on the IFAS train.
Yeah, so this is simply just technical reasons, not fundamentals. What do you guys actually trade, actually, for all our friends out there? I mean, so we have got quite a bunch of good questions, but the team seem to kind of focus on the mid to small cap companies. Is that is that something that you guys, is quite a big focus in your portfolio? It's okay. Everybody is shy here. All right. Maybe I could just, because we have a few more minutes, you got a question, just shoot. All right. If not, I'll just rattle on a little bit. Generally, my portfolio process is I don't like small caps to mid caps, not for my long-term portfolio. I do trade, right? So I'm kind of bipolar in that sense. So for my long-term portfolio, it's gonna be the very boring stuff, big cap companies, household names, and I don't really trade Singapore because trade Singapore not very terribly exciting, right? So I normally trade US. So that's big caps for the long-term portfolio. Then I've got the play money, right? The play money is where I just go in and just trade for fun. All right. So that one is normally I trade leverage ETFs. So in the US, you've got this ticker called the TQQQ and the UPRO. TQQQ is a 3 times leverage Nasdaq ETF, and UPRO is the 3 times leverage S&P 500 ETF. Leverage, so that means when it drops 3%, that means my thing will drop 10% as 3x. But of course, when the ETF goes up by the underlying index goes up by 3%, the ETF price goes up by 9%. So I kind of bipolar. So in that sense, I don't normally trade mid to small caps, not for my trading portfolio and not for my long-term portfolio. Right, so I like things which I understand has got a lot of bulk, right? So it doesn't drop like 5 cents to 3 cents within 2 weeks. It's and I do understand the product, so that's kind of me. So we got a question here. A significant part of my portfolio is limited SGS stocks as I'm buying through SRS. Okay, that's good. That's fair. My cash is mainly in the US company. Okay, so just for me to understand, you have got Sing dollar stocks bought through SRS, but your cash, not through SRS, but your cash purchases is mainly the US, right? Yeah, okay, so that's okay. Do you have a specific question about that? I think that's entirely fine, and that's exactly what I'm doing actually. Oh, it's not a question. Okay. Is this CK talking here? Okay, so yeah, okay, no. So we're on the same page here. Yes. So our play money is go and play around our US markets, right? And then our long-term portfolio will be CPF investment scheme, SRS, whatever. All right. So yeah, that's a very viable strategy, right? And I'm glad that you and maybe others are looking at foreign markets as well. Simply because you want to have a well-diversified portfolio, so you don't just look at Singapore markets. And really, on a day-to-day basis, we use a lot of products that are made overseas, like the Apple phone and I don't know, the monitor, or the car that you drive, or the things that you eat, or the shampoo that you use, like Procter and Gamble, Johnson and Johnson, that kind of thing. All these are very big companies in the US, or the Post-it notepads that's from 3M, right? So yeah, so that's why I personally like buying or trading in US companies, because I guess I do understand the product a little bit more. All right. Now, obviously, on the Singapore side, for long-term portfolios, you can look at things like again REITs, telcos, Singtel, StarHub. Some of you might think that those are very boring, but that's precisely the point. They are boring. That's why you can use your CPF or your SRS to buy, right? Just keep there. Okay. Not going to be terribly exciting, but after 5 years, I think Singtel is still going to be around, so that's going to be okay. And I think we've got 2 more minutes. Okay, so there's a question. Volume has come down. Markets continue to go up. Okay, that's not a good sign. Yes, if the markets are going to drop, what kind of levels are you looking at? Yeah. So I don't think it's okay. So the traditional benchmark for a correction is 20% or more, right? So if the market drops 20% or more than 20%, that's seen as not correction, but basically a structural issue. I don't think so. I think it's, as you can see, the markets have been led upwards really because of the technology stocks. So the Nasdaq is basically going berserk, right? So if anything, it's probably going to be between, or rather, not more than 20%. All right. So any kind of pullback is probably going to be CK. How are you doing, CK? So any kind of pullback is probably going to be profit taking, because we're heading into the overbought territory for a lot of these companies. And that's why, if it drops, I don't think it's going to be more than 20%, because more than 20% will probably indicate there's some kind of structural issue. I don't think that's the case. All right, so it's probably not going to be more than 20%. But the interesting thing, again, the interesting thing, right? If you look at Apple, right, Apple has not gone that crazy, compared to some of the other Nasdaq stocks, right? And I think Apple is, and again, this is a little bit of xiao guoyu here, because I personally quite like Apple. If you look at some of the technology news, recently Apple has launched their new M1 chip for their Mac, right? M1 chip. And I tell you, this is a fantastic CPU, right? It blows away anything that Intel and AMD has, and it's low power, so they can use it in their Macs and all that. So on a per watt basis, right, the performance is so fantastic. It's better than Intel, better than AMD. Right, give it another 5 years, right? I think this chip, if Apple continues to refine it, right, it's going to be a huge game changer. Right, the performance on a per watt basis is fantastic. So I think it's a kind of a medium-term bet. I think Apple is, gonna gain a lot of market share in the CPU space at the expense of Intel and AMD in the next few years. Of course, the downside is that Apple Mac, what do you use it for? You can't, a lot of the enterprise software, at work and all that. Of course, Office, yeah, Mac has got Office, but enterprise software, things like SAP or I don't know whatever it is, right? They don't really run on Mac. But the thing is, if Apple can provide a very compelling reason for that, right? I think it's a lot of the enterprise software we migrated to the Mac OS system, and I think that's going to be a huge problem for Intel and AMD. Anyway, if you didn't know, Intel is in deep trouble already. Has been surpassed by AMD. Yeah, so that's basically the Apple thing. So I intend to buy Apple in the long run. I've not bought it yet, simply because I'm waiting to see, waiting to see whether the ascending triangle, play will happen, right? But I do intend to buy Apple pretty soon. Basically, it's a long-term bet. Okay. One last question. I think we got one last question. It's already 2 minutes past 8. How to make sense of the current valuations in the US? We have already reached pre-COVID highs at the time. Yeah. So I guess this is supplemental to what we had discussed. So the Nasdaq is basically, I think, overvalued, right? The S&P 500 is heading that way as well. I think a lot of it is based on expectations that if anything gets worse, the central banks, especially the US, will come in to save the stock market. As it is, there is momentum movement on the US, on the part of the US Congress, to get some kind of relief bill through, and they're talking about $900 billion or something?
908 billion.
And 908 billion. So it's far less than what the Democrats want, but at least they are talking again, right? So if they pump in another 900 plus billion, and then the US Fed also continues to hold interest rates down, then that's going to be good for equity markets, because that's exactly what happened in the great financial crisis. So 10 years ago, 2008, 2009, basically the US government as well as the central bank kind of in a concerted effort basically made the they basically created conditions where you have got a 10-year bull run in the US equity market. So I think that's all good. Cheap money is always good for stocks. Okay, so that's how it is. But right now, I wouldn't buy Nasdaq or any like Amazon and all that. Probably overpriced. So wait for it to correct first. Oh, the other thing about the correction, right, is I think if you look at the put call ratio, the number of put options versus the number of call options, it is pretty low. I think for every 10 calls out there are only 4 puts. That is a traditional signal that the stock market is overpriced. There should be some kind of pullback or profit taking or, real soon. So that's the traditional sign. All right. So, yeah, so I wouldn't deep into the waters right now. Too many sharks. Of course, that might change after Christmas. We'll see how. But at the very least, I'm going to get myself a new monitor. Okay, and that is a wrap. We don't have any more questions, and we run out of time. Mr. Fang Boon, do you have anything else to add?
No, I think you have covered everything very well. So I think just on the administrative side, the next session that we have will be on the 6th of January. So that will be after Christmas, and then I suppose you'll come with a new monitor then. So,
I need to negotiate the wife.
yeah, I mean,
Okay.
Christmas.
Yeah. All right. So the takeaway is that we will take a look at Hong Kong land as well as MM2 Asia. Okay. And also for our friends out there, you know, we really want to help you guys understand some of these stocks. If you could, you know, let us know what stocks you're interested in, maybe by Monday, because we do this call on Wednesday evenings, but by the end of Monday, if you could just let us know what stocks you're interested in. So on Tuesdays as well as Wednesday mornings, we can get going on the research and we can come back to you on that. All right. So yeah. So that'd be great. Okay, but the next session we'll talk about Hong Kong land and MM2 Asia. Now we do have a last one more thing we need to do. Yes, so there is the QR code. Now the QR code is basically to help you get to the right website to subscribe to our mailing list, as well as sign up as a member, right? And I think it's all great simply because it's pretty cheap. How much are we charging? Is it like $12? Was it?
I thought it's $1 a month, so $12.
$12.
I think if I'm not mistaken. Yeah, $12 per year.
$12. Okay. So just in the interest of full disclosure, I'm now heading into the advertisement section of our talk today. $12 a year. Oh my God. If I take a cab to my office, right, and we're not talking about peak period, right? So maybe about 10:30, take a cab to my office. It's already $10. Yeah, so this is $12 for 1 full year. So you get to hear Fang Boon as well as myself talk about things of interest and some things not of your interest and some very lame jokes, but all for a low price of $12. I think it is a steal, but of course I am biased because I work at SIAS, so that's Fang Boon. But I think $12 is quite okay lah. 可以啊，对不对？
Yep.
Yeah,
I mean, it's like some brokerage charge more than $12 per trade.
Yeah, we shouldn't point fingers, but yeah, $12 划算, I think 划算. Huh? All right, and just to remind you, we are a non-profit. I'm not selling koyo here just to make money. We are a non-profit, all right. So whatever we charge is basically to cover costs, and really our mission is to help you guys out there trade safely. That is kind of the fun part of being part of SIAS. We're not here to really make money, although we do enjoy making money, but that's not really the part of the job here. Okay, so do sign up if you're not a member, get on our mailing list, and we will see you at the next session. Right. Do you guys know that we do have a call on Mondays as well? So Mondays we have got the market review call, and then Wednesdays we have got this SIAS call. Right. So it's two slightly different topics, but what we're trying to do is to increase our programming just to get in touch and stay connected with you guys. All right, so that's it from us. 8 minutes past 8. If you've not had your dinner, and it's a good time to just log off and get some makan. Exactly what I'm going to do. Okay.
Okay, thank you.
Thank you very much.
Thank you, and we will see you after Christmas.
Yeah.